And it goes a little something like.
Financial market. What is financial market? A financial market is a marketplace where financial securities such as stocks, bonds, currencies, commodities, and derivatives are bought and sold. Financial markets can be divided into two main categories. First is capital markets, where long-term debt and equity securities are traded. Examples include the stock market and bond market. Second is money market. Money market where short-term debt security are traded. Example include the repo market where repurchase agreements are traded, and the federal funds market where banks borrow and lend money to each other overnight. Functions of financial market. Financial markets serve several important functions in an economy. These include facilitating the efficient allocation of capital. Financial markets allow investors to buy and sell securities such as stocks and bonds, which help to match borrowers, companies, and governments with lenders, investors. This allows capital to flow the most productive uses, which can help to promote economic growth. Providing liquidity, financial markets make it easy to buy and sell securities, which help to ensure the investor are able to quickly and easily convert their investments into cash. This is important because it allows investors to respond to changing investment opportunities or financial needs. Helping to manage risk, financial markets provide a way for investors to diversify their portfolios, which can help to reduce the overall risk of their investments. By spreading their money across different types of securities and investment, investors can minimize the impact of any single investment that performs poorly. Helping to set prices for assets. Financial markets allow investors to buy and sell securities, which help to establish the prices for those securities. This is important because it provides investors with the information they need to make informed investment decisions, and it helps to ensure the prices accurately reflect underlying value of securities. Helping to raise capital. Financial markets are an important source of capital for companies and governments. Companies can raise money by issuing stocks, and government can raise money by issuing bonds. This allows companies and governments to expand their operation and invest in new projects, which can help to promote economic growth. Indirect finance. Indirect finance refers to a way of obtaining funds in which borrowers raise capital through intermediaries such as banks and financial institutions, rather than directly from savers or investors. Indirect finance allows borrowers to have greater access to a larger pool of capital from a wider range of savers and investors than they might otherwise have. It also allows savers and investors to have a greater variety of investment options and to diversify their portfolios more easily. It also enables the intermediaries to take advantage of their information advantage and assist to funding sources to enable better decision making and risk management. Types of investors. Banks. A bank is a financial institution that accepts deposits from the public and creates a demand deposit while simultaneously making loans. Lending activity can be directly performed by the bank or directly through capital markets. because banks play an important role in financial stability and the economy of a country. Most jurisdictions exercise a high degree of regulation over banks. Most countries have institutionalized a system known as fractional reserve banking, under which bank holds liquid assets equal to only a portion of their current liabilities. In addition to other regulation intended to ensure liquidity, banks are generally subject to minimum capital requirements based on an international set of capital standards, the Basel Accords. The historical of bank. Ancient. The concept of banking may have begun in the times of ancient Assyria and Babylonia by merchants offering loans of grain as collateral within a barter system. Lenders in ancient Greece and during the Roman Empire added two important innovations. They accept deposits and change money. Citation needed. Archaeology from this period in Iran, ancient China and India also shows evidence of money lending. In medieval, the present era of banking can be traced to medieval and early Renaissance Italy. The rich cities in the century and the north like Florence, Lucca, Siena, Venice, and Genoa. The Bardi and Peruzzi families dominated banking in 19th century Florence, establishing branches in many other parts of Europe. Giovanni de' Medici set up one of the most famous Italian banks, the Medici Banks, in 1997. The Public of Genoa founded the earliest known state deposit bank, Banco di San Giorgio, Bank of St. George, in 1407 at Genoa, Italy. Angel investors. An angel investor, also known as a business angel, informal investor, angel founder, private investor, or seed investor, is an individual who provides capital for a business or businesses, including startups, usually in exchange of convertible debt or ownership equity. Peer-to-peer lending. Peer-to-peer lending, also known as abbreviated as P2P lending, is the practice of lending money to individuals or businesses through online services that match lenders with borrowers. Venture capital. Venture capital is a form of private equity financing that is provided by venture capital firms or funds to startups, early stage and emerging companies that have been deemed to have high growth potential or which have demonstrated. Personal investors. Over recent months, there has been an increase in interest among personal investors in finding out about gilt market and the investment opportunities gilts. However, for the purposes of debate, personal investors are remarkably tax sensitive.